All right, you guys are live. Thank you guys for coming.
Jonas, thanks for having us. And Jeff, who's not there just yet, thanks for having us. Hi, guys. Good to see a lot of you again. We presented a while back. I'm not sure in the time frame, maybe 6 months ago, maybe a year ago. And we talked about taxation of crypto. And Jeff asked us to come back and talk about charitable remainder trusts. And before we get into that, a little disclosure on that. We've never done a charitable remainder trust, but we've studied up and we figured we'd do this in kind of a Socratic method, if you will. So we may ask you guys some questions, you guys ask us questions, and together we'll try to achieve answers. We've got, to refresh you, we're a small boutique firm that deals a lot in crypto. We got a lot of clients over the past year because a lot of CPAs wouldn't touch crypto. And with that, we accepted the challenge, and we've done a lot of good things for these guys. And charitable remainder trust sort of falls in this pocket. We're a small firm, about 8 people total, or 12 people total, I should say, with our administrators. And we're part law firm and part CPA firm. So with that said, my name is Chris Wojcicki, as it shows up on the board. We have Dan O'Connor, who's an associate attorney with us, and Dan would be the one that would draft any charitable remainder trust that we do. And we have Sean Mulroe, who in my mind is one of the greatest tax minds in the country. He's unbelievable. He's my business partner as well. And in our studies, we've learned that the fundamentals of taxation really are applicable to the charitable remainder trust function. And with that, why don't we start with the definition of what a charitable remainder trust is? We'll have some time for Q&A, but if you guys, for the audience that we could see, if you guys want to ask questions while we're going along, feel free to raise your hand and maybe we could field those, and it just adds to the conversation. But Dan, would you launch us with a little explanation, just a basic explanation of what a CRT, we'll refer to it as a CRT from here out, what Absolutely. A CRT is? Thanks.
Yes. So the central idea of a charitable remainder trust is to reduce taxes. And this is done by first donating assets into an irrevocable trust and then having it pay one or more non-charitable beneficiaries for a stated period of time, which can be no longer than either 20 years or the life of one or more of the non-charitable beneficiaries. The payments can be made annually, semi-annually, quarterly, or monthly. Once the time frame expires, the remainder of the estate is transferred to one or more charitable beneficiaries. One thing to keep in mind with these charitable remainder trusts is you have to have a charitable intent when you create it, since the remaining assets when you die will be used to send money to a charity of your choice.
So just for sake of conversation, I'll kind of MC this and we'll go back and forth between Dan and Sean. We sat there and we said, hey, this is a pretty cool vehicle. But as we sort of looked at ourselves, we're like, boy, you really have to have this charitable intent for this thing to be worthwhile. You also need to have kind of a big capital event coming up, which is where it's applicable to crypto. You know, we've had some success stories where people bought $10,000 of crypto and it's now worth $500,000 or $1 million, and their gut's telling them, hey, let's get out, let's sell this thing. And the CRT could be a really good vehicle for that. So I wanted to throw that out there. Sean, you want to add anything at this point?
Yeah. So
you're a little low on volume.
Yeah. Any better now?
Question over here.
Oh, yeah. Got it.
Are okay with a question?
Sure.
At this point, hey, so are we defining a charity as any 501c3, or what is the definition of a charity in this case? Because that's actually it could be quite a large umbrella term that could be used for quite a few things.
Sure, I could grab this one. It is a 501c3. You know, it has to be a legitimate charity. But to add to that, you could also do a private foundation.
Okay.
Yeah.
So even some law firms that will litigate on behalf of certain causes would qualify as a charity under that definition then as well.
A law firm would not.
You would not. Well, I believe there are some legal foundations that go and litigate on behalf of various causes. I think they're C3s. Am I incorrect in that assessment?
I think it depends on what you're describing there. So a law firm itself is a for-profit entity.
Not sorry.
Yeah,
Wrong
but
term for that.
sure. But a law firm and any citizen is allowed to set up a 501c3. Sure.
Yeah.
And we've actually set up a couple of those in the past. It's kind of a rigorous process. I think the founding IRS form is a Form 1023, and they've expanded it to where it's, I think, over 40 pages now. It's quite a process to set it up. And the reason it's so difficult is charities are, riddled with fraud on this thing. So they want to check the legitimacy of charities on this. But yeah, for a CRT, it's got to be a 501c3 recognized charity or a private foundation.
Okay, great, thank you.
You got it.
Perfect.
Sean?
So my volume back, Chris?
Oh yeah, you sound good now.
All right. So just want to dive a little bit more into the details of what a CRT is, because there's actually two different types. When you guys go and, you're looking into this, you're going to see that there's a charitable remainder annuity trust. And effectively what that does, because they both start the same way, where you have a very highly appreciated asset that you're looking to sell. But the idea behind it is that if, say you were to go to sell your asset today, and let's go in, Chris's scenario where you bought Bitcoin for $10,000 and then now it's appreciated up to $1 million. And let's just assume that when you're all said and done, between the federal income tax rate, so the long-term capital gains rate of 20% plus the net investment income tax, which was put in back with the ACA, is 3.8%. And then depending on your state, you could actually, be as low as no tax, but there's some states where you can actually get crushed. So you're going to be somewhere between 24%, maybe even all the way up to 30-something%. So let's just say, for sake of argument here, that you end up being at about 30% tax rate. You're going to give almost $300,000 away to the IRS. So when you start looking at it, you're like, wow, I could really sell this, but then I walk away with, maybe $700,000, which is great, but leaves a bad taste in your mouth where you're giving away $300,000. What you could do is you go and put your Bitcoin, you gift it over to an irrevocable charitable remainder trust. So not sure how familiar everyone is with a irrevocable trust, but there are a few types of trusts. But in this particular case, a charitable remainder trust is an irrevocable trust, meaning once this document is set up, it's actually a live entity of its own, and it files its own tax return, and quote unquote pays its own tax. If it weren't so, an irrevocable trust pays its own tax, but a charitable remainder trust is actually exempt, and we'll get a little bit more into that. But just so you know, like, once this asset goes in, you no longer have control over your asset. Whoever you designate as a trustee would in that case, which could be yourself if you were going to designate yourself as a trustee. But we're getting a little bit into the weeds there. But when you set this thing up, whether it's a charitable remainder annuity trust or a charitable remainder uni trust, you put your asset into the CRT and you're able to sell it, and then the trust actually pays no tax. So now, instead of having $700,000 of your asset, whether it be cash or other cryptos that you've now exchanged your Bitcoin for, now you have $1 million in your investment pool as opposed to $700,000. And then you start talking about the time value of money and what your asset, the additional $300,000, can do when it works for you over these years. You're talking about a particularly decent investment vehicle. But the part that I just want to touch on that Dan mentioned is that you got to have a charitable intent as well. The tax savings are great because you don't pay that $300,000 tax, and you actually get a partial deduction when you gift your asset into one of these CRTs. And that partial deduction all depends on, what you choose the life of the stream of income to be, whether it's over your lifetime or if it's going to be a set period of time over 10 years, 20 years. And then depending on how much you're taking out, it depends on how much of a deduction you're going to get when you put it in, because really what the deduction ends up being is the present value of whatever this future contribution to the charitable organization is going to be. So it could be, as much as 50%. Generally, it seems to come out around 10% when these things are set up correctly. Not correctly, but with the right intent of, saving a little bit of money, but also having a charitable intent. So in this scenario, if you were to put in $1 million, you might get $100,000 deduction without actually having to pick up any income. So it helps reduce your taxable income.
So
Go
let's just recap for a second. Good stuff there, Sean. So think about this. You set up this trust. Instead of having $700,000, you got $1 million working for you. You can get a stream of income out of it. We'll talk about that in a little bit more detail in a minute. And maybe Dan, you'll tackle that, and Sean can help you out if you need. I don't know about the stream of income that's coming out. Well, you got this $1 million working for you. And on top of that, you get this benefit of this charitable deduction. I was actually watching a stream today on CRTs, and they used about 20% as a ballpark, and I like that number better. So let's say you get a $200,000 deduction if you set up this $1 million CRT. So pretty cool mechanism at this point. Again, keep that charitable intent in mind, because at the end, instead of the money going to your heirs, it's going to go to a charity. So you have to have that charitable intent in there. Dan, can you talk about a little bit, if you're comfortable, on the stream of income coming out? So here we are. I got a Bitcoin. I'm up, whatever, $900,000 or $1 million of gain I'm looking at. I put this into the CRT. I saved myself $300,000 in tax. I want to get some of that out. How much can I get out?
So you can choose a set amount, I think up to 50%, that will be distributed out to you over the duration of your charitable remainder trust. And like I said, it could be annually, semi-annually, quarterly, but you'll receive those payments over the duration of this charitable remainder trust. And that's coming from the earnings made from the asset that you put into this trust.
And so I'm going to touch base a little bit on that too. So as the tax guy, I'm going to let you know that everything isn't tax-free after it's in the CRT. So there's two types of CRTs that I mentioned, and we're going to primarily focus on the second one, but I'm just going to touch briefly on the first one. So a charitable remainder annuity trust is where, say you put the $1 million in, you actually set over the period of time where you'd be receiving a stream of income, whether it's yourself, or you could actually designate another individual, whether it's your children or your spouse or anyone like that, to receive this income. But you'd say, all right, out of this, I want to receive $50,000 a year. So it's a set dollar amount as opposed to a percentage. So that's out of the annuity trust. So it doesn't matter if the investment in the asset or in the trust skyrocket, and now the charity is going to receive this big windfall at the end. You made that set annuity of, say, $50,000 or whatever that dollar amount is. The other piece that actually probably more appropriately would be the choice for our crypto folks would be a charitable remainder uni trust. And that's for a couple of different reasons, is that you actually set a fixed percentage of the assets within the trust that you'll receive as a stream of income, whether it's, monthly or quarterly, but for that year, and it's revalued at the beginning of each year. So in January every year, you'd look at the value of the trust and say, hey, I'm supposed to get 10% out of it. If the value of the assets trading are $100,000, you get $10,000. But if, when crypto bounces back and that thing jumps back up to $1 million, then in that year you get $100,000 of income. And then the good part about the CRUT, so they call them CRUTs, so the charitable remainder uni trust, is that actually you can make contributions to the CRT again later in your lifetime. Say you have another highly appreciated asset and you like how this vehicle is working, and you like the charitable organization that you picked, you can gift another Bitcoin or another set of Ethereum or anything like that. Really, it doesn't even just have to be crypto. If you have a highly appreciated real estate or piece of real estate or any highly appreciated asset like stock or anything like that, you could do this with. But one little piece, and I'll shoot it back to Chris, is that when the income's coming back out to you, it is a stream of income that is taxable to you. So depending on the type of income that's being earned within the trust itself won't pay any tax, but any income distributed out to you will be taxable. So if the trust is creating a bunch of short-term capital gains by trading cryptocurrencies, when you get distributed out money, you're going to be distributed out short-term capital gains. Or it could be ordinary income, depending on what the trust ends up investing in. Most likely, in the most ideal situation, is that the trust is also holding on to long-term assets and creating long-term capital gains. So anything that is being distributed out to you ends up being taxed at that more favorable long-term capital gains rates.
Good stuff, Sean. Dan, let me ask you a question on that too. Suppose, so you set up the CRT, you're saving taxes, you got this charitable intent. You've got a charity named in there and you lose favor with that charity. You want to change the charity. Can you do that? And can you name more than one charity?
Yes, and yeah, not only I think you can change the name of the charity, but you can also have multiple charities listed as beneficiaries or beneficiaries down the line with your charitable remainder trust.
Got it.
So yeah, and as guys I was mentioning, with your trust being irrevocable, there's nothing you can change once it gets rolling. That's actually one of the exceptions with a CRT, is that you actually have that flexibility. So that is the good part about these, is that if you do have a particular organization that you like or it changes, you do have that flexibility to change.
Okay. And then let me ask you guys, while we got this momentum, another question, and then we'll take some questions from the audience there. So I throw my $1 million of Bitcoin in there, and suppose I don't sell it right away. It's doing pretty well, turns into $1.5 million, and I got to get some money out to pay college tuition. Can I loan from my CRT?
Unfortunately, no, you cannot.
Okay.
No, the only stream of income you're going to get is that set amount of that income stream.
Okay. Suppose, another question for you guys. If I had, let's shift it over to real estate, and it could even be a margin account with cryptocurrency. But if I have an asset that has debt tied to it, you know, I borrowed from the bank, or I have a margin account with my exchange for crypto, can I put that in my CRT?
Sorry, you cut out in and out on me there, but it sounded like, yeah, if we've got a margin account or any other kind of investment account, can we put that in? Is that the question?
If an indebted asset, can you put an indebted asset in?
In theory, you could, but really they're not. I mean, so what's going to happen is there's different types of debt out there. So I'm not sure how familiar our audience is with types of debt, but there's recourse debt and non-recourse debt. So debt that's not directly tied to the property, or recourse debt of the property, where essentially what's going to happen is that if the asset's able to be transferred to the charitable organization without taking on any of the debt, then you're okay. Then the individual still owes whatever this debt is, but a lot of debt associated with property is considered recourse debt, where part of the reason why a bank would give you money to buy or purchase that property is they're saying, hey, you know, we are going to hold a lien, or not necessarily a lien, but use this as collateral for your loan. So then it becomes recourse, so that you need that property in order to hold that loan. So in a lot of scenarios, it's going to be no. So you're going to need a asset that's clear of any debt in order to contribute that to this CRT.
Thanks, Sean. And then just to kind of gauge cost of setting up a CRT, we've done a little bit of research on that, and it seems they run anywhere from $5,000 to $20,000 to initially set up, closer to the $5,000 mark. And then there's an annual maintenance, especially on a CRUT, because you have to do that revaluation every year on it, and that runs between $2,000 and $3,000 is what that runs on an annual basis. So those sound like pretty high numbers, but again, put it in the context of our hypothetical here, where you're saving $300,000 in tax, and you can continue to contribute appreciated assets to your CRT. How about, does anybody have any questions at this point?
Are those expenses are paid by the trust itself? Is that correct?
That is correct, I believe.
Yeah. And then the other, to Sean's comment, he said quite a few things, but the gist of it seemed to be, so if it's recourse debt like a mortgage, that you could not put that into the trust, like it had to be.
Yeah, the trust can't assume any liabilities on behalf of the individual contributing to the CRT. So if anything's tied to the property that can't be separated out, and use other collateral to maintain that loan at the individual level, the property or whatever it is cannot be contributed and get this tax benefit of the CRT.
Okay.
And for a minute, oh, go ahead.
I have a question. So in setting this up, do you maintain custody of your assets? Meaning that, like, I have a ledger wallet and I have a Bitcoin on it, and I put this into the trust. Do I have to put this at an institution like at a Coinbase, or can I maintain custody of this within the trust?
I'm gonna let Dan answer that question, but it's funny because that you're a mind reader, because that's just what I was going to bring up, was some of the operational mechanics of how this works. Dan, do you want to answer that question?
Well, I believe you can maintain control of that asset while you put it into the trust. So then you can control just how that asset is handled, but it is being placed within that charitable remainder trust.
Yeah, so
But go ahead, Sean.
as we mentioned before, so the CRT is actually its own living taxpayer. So when you contribute that asset into the trust, you no longer own it. The trust owns the asset, but you have the opportunity to name yourself as the trustee. So the trustee is the one who manages when the money's sent out for the stream of income, how the assets are handled. So if you're the trustee, you certainly can decide whether or not, hey, this is a good time to sell Bitcoin or buy a different particular asset or whatever you're doing within the trust and investment portfolio. So you do still have control if you name yourself as the trustee.
Now here's an interesting thing, and I don't know if I have an answer. Let's just talk about this in theory. So when you set up the CRT, just like Sean described, think of it as its own living person on this thing. It's separate from you. It gets an EIN number, federal employer identification number, which is like its social security number. And then you're supposed to open up a wallet or an exchange in there. And we know transfers between wallets is not taxable. But if you transferred between an exchange, that might be taxable. Would you, Sean?
No, it's fine as long as you're just sending the assets. So, if you send money from one wallet to another, whether or not it's from you to anyone else, between your spouse or whatnot, then it's just, you're moving money back and forth. But if you were to send money to, say, your child or anything like that, it's technically a gift. And you're going to run into gift tax issues. But because of what you're doing here, it's treated as a gift in the tax or in the CRT world. You're not going to have any gift tax issues. You're actually going to have the benefit of this actually being your contribution to the CRT, which is, you get a partial tax deduction based on that present value of what the future contribution to the charitable organization is going to be. So you would have to send it to another asset, but do not, if you're going to do this, don't liquidate your Bitcoin in your own wallet, then send the cash to a different wallet that ends up being put in the name of the CRT. At that point, you've liquidated the asset in your own name. You'd have to actually send whatever the highly appreciated asset is, whether it's a crypto, whether it's a piece of real estate. Don't sell the real estate and then contribute the cash. You got to actually change the title of the asset into the name of the trust. So in a crypto sense, yes, I would set up, at that point you'd have to set up, some sort of exchange either with Coinbase or whatnot to eventually liquidate it, but in the EIN, so the social security number of the trust. And then I would recommend having a separate wallet that is, even if it's one of these, not like a MetaMask wallet or something like that, where it's not technically tied to anyone's social because you don't have a know your customer when you're creating those. I would set up a new wallet that's just for the trust. So there's no commingling. The IRS can never come back in and say, hey, this was truly just in your wallet the entire time, and then you just sold it and now you're doing different things with it. Separation is key here. You got to be able to substantiate the fact that you truly did this in the charitable intent of the CRT and actually not just trying to evade taxes by setting up a phantom CRT.
Just to, Sean, that was really good. And we'll take that question in 1 second, just to throw something out there. By show of hands, who out there has set up an entity for their crypto businesses, like an S Corp or anything like that? Can you raise your hands if you did? Really? Nobody has an entity out there? Nobody has a S corporation? Okay. A whole separate topic on that. We won't go down that, but
I actually went to a crypto attorney, and they recommended not to set one up.
interesting.
Some of it had to do with the amount of crypto that I had, but with the expenses and all that, there wasn't an appreciable tax benefit to setting it up. And that's going through and setting up a company versus just counting it as individual income.
Yeah, I mean, there's two different things, and I won't go too deep into it. I know that's not the idea of today's conversation, but if you're just trading, then there really is no difference because it's all going to come through to you as short-term or long-term capital gains anyways. It's once you start getting into different projects like staking and nodes and things like that, and if you get enough volume where you're going to create enough self-employed income, that the additional self-employment income is 15.3%. So once you start getting into those types of activities and you have substantial income, you're going to pay an additional 15.3% if you don't have an S corp set up purely on that staking or node projects or mining type of activities. So if you got those things, you guys might want to consider doing it.
Yeah. So well said. If you're trading, don't worry about it. And the reason I brought up the S corporation or the survey to see if anybody's got an S corporation is, if you wanted to just contribute your appreciated S corporation stock to a charitable remainder trust, that doesn't work because there's a limitation on who could be a shareholder in an S corporation. So that would be a planning thing, before we pulled any of these triggers, depending on your circumstances as we go in there. So that's why I want to throw that out. The gentleman in the back had a question before. I'm sorry.
Yeah, no, that's fine. And I'm not quite sure how to ask the question, so maybe you can help read the tea leaves on it.
Sure.
Just to create a scenario. So I am a business owner. I am and let's just say I'm 50% owner with another entity of the business. Can I put my portion of the business into a trust for legacy purposes so that if something would happen to me or I step down or whatever in that controlling aspect of my ownership part of the company, can that be put into a trust and then have someone designated to continue the operations on that, basically name someone else as trustee?
I will.
Overthinking it.
Sure. No. I'll field this one. So two things are. One of them is a little bit of a cart before the horse. So the entity that you own 50% of, let's say, on this, there's a controlling document on there. And so if you wanted to transfer your shares, there's going to be a whole section on who you're allowed to transfer your shares to. That said, you putting your shares or your ownership in a trust will certainly work in that regard to see who may be able to make decisions on your behalf. So if you're not here or you're incapacitated and your shares are in the name of your revocable trust, let's say, your trustee will be able to make decisions on what to do if you still retain your ownership. And the reason I say if is whatever entity you're in, it's got a controlling document, either an operating agreement or bylaws. And there's usually a transfer of share section in there. So if something happens to you, typically that entity doesn't want to have some trustee that they don't know as a partner in there. So there's a mechanism in there where you're compelled to share the shares back to the entity, and they replace you as partner that way. Does that make sense?
Yeah, it does. Thanks.
Okay. And it begs a good point out there, and everybody looks pretty young. By show of hands, who's got their will done, their estate plan done? Good. Not bad. So 50% of you guys, the ones that don't, highly encourage you to do it. And the other important component on it, we're not getting any younger, is make sure you got yourself properly insured too, as you go forward. We could help you with all of that stuff as well too, if anybody has any questions in that regard or needs any help that way. But back to CRTs in the meantime, quick little recap, and then we'll field some more questions if you guys have any. So kind of a neat vehicle. It seems like the overriding factor, and I'll miss a couple things here, is you need that charitable intent, because it's going to, if it grows, whatever's left is going to go to a charity, and you have to be willing to do that. It's not going to go to your heirs. And you don't have to put everything in there, so you could have separate stuff for the heirs, and you could still use the mechanism of the CRT. The other big plus on it is that tax savings. So remember that time value of money. So in our hypothetical, instead of having only $700,000 working for you for the remainder of your life, you got $1 million in this scenario working for you. And that's a big difference on the time value of money. And then the kicker they give you is you get this immediate charitable tax deduction that's somewhere between 10 and 20% of what you put in. So if you put in $1 million into your CRT, you got an immediate $200,000 charitable deduction, which don't know what everybody's making, but that should eliminate your tax bill for a year or two or three on there. There's a limitation on what you could deduct charity-wise It's right now it's 60%, I think, Sean,
Yep.
of your income for the year. So if you had this $200,000 deduction and you make $200,000, you're limited to $120,000, and the $80,000 of that 200 would get carried over to the next year, and you could use it then. And you got 5 years to use it up. Does anybody have any questions? Okay. How do we do for not knowing anything about CRTs? We do pretty good. Good.
Sounds good to me. I'm going to see if we have any questions from online.
Sure.
Well, we might. Nope, nothing here.
All right. All right, guys. Well, if anybody has questions down the road, feel free to reach out.
Thanks, Chris.
All right,
Awesome.
guys.
Thank you.
Great job.
All right. Thanks, everybody.
Take care.
Chris.
Bye-bye.
Have a good one.
Thank you.